The biggest investing mistake in 2026 may not be picking the wrong asset. It may be investing with the wrong setup under it, which is a quieter mistake and often a more expensive one. A lot of people think investing readiness starts with market research. They watch rate decisions, inflation updates, AI headlines, ETF comparisons, and year end forecasts, and all of that can feel responsible. But sometimes the questions that matter most are much less exciting. Can your month absorb a hit without forcing you to sell? Is your debt already charging you more than your likely return? When will you actually need this money? Are you using the right account before you even choose the asset? And are you buying real diversification or just a cleaner version of concentration? If those answers are weak, investing can still be the wrong move, even when the market looks attractive. This video will make the pre-investing decision clearer, so you can tell whether investing right now fits your financial setup or only sounds like the right next step. Now, to be clear, this is not a video about avoiding investing in 2026, and it is not a video about trying to predict the market. The point is simpler than that. If you are planning to invest in 2026, the mistake is often not what you buy. It is what you fail to check first. And that matters because 2026 is still not a nothing can go wrong environment. Rates are not back in the ultra-cheap world people got used to years ago. Inflation has cooled, but not enough to disappear from the picture, and market leadership still leans heavily on a narrow part of the market. So if you are about to invest, the useful question is not, what is the best thing to buy right now? The useful question is, what needs to be true before investing is actually a strong move for me? Most people think investing readiness is mostly about knowledge. They assume that once they understand enough about ETFs, feel calm enough about the market, or hear the right macro story, they are ready. But readiness is often much more structural than intellectual. You do not need to know everything before you invest. You do need to know whether your financial base can support the decision. That is the reframe for this whole video. Before 2026, investing becomes an asset question. It is a setup question. And there are 5 factors that matter much more than most people admit. Factor 1 is your cash buffer. Not because cash is exciting, it is not. It matters because investing is much easier to hold when ordinary life cannot break the plan right away. Imagine 2 people who both want to invest $500 a month. The first person has fixed monthly essentials of $2,413.47, keeps about $8,200 in cash, and has a stable job. A rough surprise month hurts, but it does not destroy the plan. The second person also wants to invest $500 a month, but only has $1,146.53 in cash. Rent just went up, and one annoying expense would push them onto a credit card. On paper, both people are starting to invest. In practice, only one of them is doing it from a base that can survive normal life. That is the point. A weak cash buffer does not just create discomfort. It increases the odds that your investment money becomes emergency money at exactly the wrong time. And that is where investing stops being a long-term decision and starts becoming a forced liquidity problem. Factor 2 is debt cost. This is where a lot of people get seduced by average return talk. They hear that stocks might return 8% or 10% over long periods, and then they start treating all debt like a minor side issue. But debt is not one thing. A 4% fixed loan is not the same as a 26% credit card balance. If you are paying 24.47% on revolving debt, you are fighting a very expensive guaranteed drag while hoping for a long-term uncertain return on the other side. That is not investing discipline, it is bad ordering. Now, that does not mean every debt should always be paid off before every dollar is invested. A very low-rate loan is different. Employer-matched decisions are different. Tax-advantaged contribution windows matter. But high-interest debt changes the whole conversation. If your debt is already compounding against you at a level that beats or seriously challenges your expected return, then your first investing factor is not which fund. It is, why am I trying to outrun expensive drag with uncertain upside? Factor 3 is time horizon. This one gets ignored because people talk about investing as if it is one generic action. It is not. If the money is truly long-term, then volatility is part of the game. If the money may become a house down payment in 2 to 5 years, or tuition money, or relocation money, That changes the job of the money. And if you ignore that, you can end up using long-term tools for short-term goals. That does not always look foolish at the start. It usually looks reasonable right up until timing matters. Let's say you have a monthly surplus of $3,003.47. You already have some retirement savings, but you also think you may want to buy a home within about 5 years. In that case, should I invest more? Is not a complete question. Part of that surplus may belong in long-term investing. Part of it may belong in safer, more liquid reserves for a near-term goal. The real decision is not whether investing is good, it is whether this specific money has a long enough runway to deserve market risk. Factor 4 is account type before asset choice. This is one of the least exciting factors, which is exactly why so many people skip it. But it matters. A lot of beginners spend more time comparing ETFs than thinking about where those ETFs should live. And sometimes the bigger improvement is not picking a different asset. It is using a better container. If you have access to tax-advantaged accounts, employer matching, or structures that reduce long-term tax drag, that should usually enter the conversation before you obsess over tiny differences in funds. Because a decent investing choice in the right account can beat a slightly better investing choice in the wrong one. This is not glamorous. It will never win the thumbnail, but it is one of the clearest examples of how people focus on the wrong factors first. Factor 5 is real diversification. A lot of people say they are buying the market and assume the problem is solved, but diversification is not just about owning a fund with hundreds of names in it. It is also about what is actually driving the returns underneath that label. If a huge share of your performance still depends on a narrow group of giant companies, then you may be more concentrated than you think. That does not mean concentrated exposure is always bad. It does mean you should understand what you are calling diversified. Because there is a big difference between, I am comfortable with this concentration and I did not realize I was this concentrated. Let me show you how these factors change real decisions. Imagine someone bringing home $5,800 a month. Core bills are $1,700. Lifestyle spending is about $1,100. That leaves a surplus, $3,000, which sounds great. But now look closer. They have $5,000 in high-yield savings, $15,500 in student loans at 5.5%, a $700 car loan at 4.25%, and they may want to buy a home within around 5 years. This person absolutely can invest in 2026, but the right question is not, what should I buy first? The real question is how much of that surplus belongs to long-term investing, how much belongs to a stronger liquidity base, and whether the debt profile and housing timeline change the order. That is a very different conversation from market timing. Now imagine a younger person whose monthly expenses are only $960. That sounds light, which makes them feel aggressive and ready, but they just drained their emergency fund. They owe a parent $3,000. They may need to finance a replacement purchase of around $4,000, and they can rebuild savings at about $1,800 a month. Here, the temptation is to say, I am young. Time in the market matters. I should still start investing now. Maybe. But the stronger move may be to rebuild that safety base first because this setup is still fragile. And fragile setups make good intentions expensive. Now take someone on the opposite end. They keep $50,000 in emergency cash, hold $41,000 in taxable investments, and have around $800,000 across retirement and HSA accounts. Annual compensation is about $260,000. This person is asking whether they really need to keep that much cash or whether $10,000 should move into brokerage. Here, the wrong factor would be blindly following a generic 3 to 6 month rule. At this level, the real question is not basic readiness. It is opportunity cost, household complexity, job stability, and what truly liquid enough means for their life. Same broad topic, totally different, correct answer. And that is why a broad investing checklist is weak. What matters is not the category. What matters is the setup. So here is the practical filter. Before you invest in 2026, ask these 5 questions in this order. First, if an annoying month hits, will I be forced to sell? Second, is my debt quietly charging me more than my likely return deserves? Third, when might I actually need this money? Fourth, am I using the right account before worrying about the perfect asset? And fifth, do I understand what I am really exposed to, or am I calling concentration diversification? If those answers are strong, investing becomes much cleaner. If those answers are weak, more market research will not fix the real problem. A lot of people think investing starts with conviction. In real life, it often starts with structure. That is the point of these 5 factors. They are not meant to make you more hesitant. They are meant to make your decision more honest. Because in 2026, the smartest move is not automatically investing fast, and it is not automatically waiting either. It is making sure you are screening the right things before you act. The market is not the only risk. Sometimes the bigger risk is building an investing plan on top of a setup that was never ready to carry it. And if you want to make better money decisions without adding more noise, that is what this channel is for. So subscribe, and thanks for watching.